The oil and gas industry in 2024 has been hit hard, and in today's episode we're going to look at some of these hugely undervalued oil and gas companies with some significant upside over the next 12 months. We're going to take a look at their dividend safeties. We're going to take a look at some of their strong financial metrics. We're also going to run every single one through our valuation model, getting to our intrinsic value as well as our acceptable buy price given our investor margin of safety. And we're going to find out what are Wall Street's forecasted price targets over the next 12 months with their upside. We're also going to take a look and see whether or not there is any insider trading with any of these four companies, buys and sells, and we'll also see which one has performed best over the last 5 years. So let's jump into today's episode and focus on the first stock, ExxonMobil Corporation, now trading at $96.80. We can see it is down slightly in the pre-market, and over the last year it is down 13%, pretty much trading right on its 52-week lows, a current forward yield of just under 4% and a forward PE of 10.4. If you've been holding this company over the last 10 years, you would be up around 2%, but do bear in mind this doesn't include those dividends reinvested. So let's take a look at ExxonMobil. Now, dividend safety, it is 80, the score is safe. Market cap, 387 billion, a mega cap company. Now, in terms of recessionary metrics, for those that see a recession inbound, well, they increased the dividend during the last recession, below average growth, negative 41% versus negative 12 from the S&P, but they did outperform the S&P with a negative 28% return versus the S&P's negative 55. Dividend growth 4.4% in October 23. We always advocate on the channel around 4% or more, whether that's your dividends, your salary, your other income producing assets, just because the US inflation rate on average over the last 40 years was 4%. Anything less, you are taking a pay cut and losing your purchasing power. 3% on average over the last 5 years, over the last 20 years 7%, so it isn't too bad considering the starting yield. They are a dividend aristocrat. They have increased those dividends for 25 years or more, 10 years away from becoming a dividend king. And this is absolutely incredible. They have been paying a dividend without a reduction for 141 years. Absolutely phenomenal. Now, dividend yield theory, for those that are new to the channel, states that the company is undervalued when the current yield sits above the 5-year average. Right now, we have a sign of overvaluation, 3.93 versus 4.73. But as always, we never look at any of these models in isolation, and we will draw conclusions towards the end. We have a sign here of undervaluation, so some contradictory evidence. Forward PE 11.4 below the 5-year average of 12.2. And in comparison, Exxon's PE is slightly lower than that of the sector PE, the energy 12.2. As always, for those that are new, again, it is a good reminder as well for regular viewers, earnings metrics data is susceptible to manipulation by management through accounting. We sit here and we focus on the free cash flow payout. It is a lot more accurate, shows a truer picture. Now, for oil producers, below 40% is the ideal target. For me, 60% on the majority of companies. Gives me faith that management are able to offer double-digit dividend increases. So 2022 for ExxonMobil, 26% of the free cash flow payout. 2023, based on their expected annual report release, 39%. So it is positive, and we should be expecting at least an inflation increase dividend this year. Free cash flow per share, well, $2.54 in 2013, $14 in 2022. It's moving in the right direction. We do see the inconsistencies, though, over a long period, but at least over the longer term, it is increasing. But as always, do note 2023 is expected to be a drop from the prior year. Now, sales growth, this is one thing we will see across all metrics in the oil and gas. This is called cyclicality. As we can see, the industry does move in cycles. We have 4 years of negative growth to the top line, followed by double-digit positive growth. And again, the cycle continues, as we can see. And 2023 is expected to be a negative 10% to that top line. In terms of total sales, well, it has gone from 390 billion in 2013 to 402. Again, this is a very good picture of that cyclicality. And over the longer term, they have returned excess cash to shareholders, as we can see here from this graph. They have been buying back shares on the net position from 4.42 billion to 4.08. Now, ROIC is one of the metrics that I do look for when investing in companies. I want to see ideally 10% or more. It gives me faith that management are able to effectively allocate their capital. The last 2 years, it has been above that. 2023, again, is expected to be above. But again, do notice that cyclicality and the volatility, hence why it isn't so consistent. And on the margins, again, a very similar story. And we will see this throughout the oil and gas companies we review today. But they do struggle with their margins. It is positive to note that over the last 3 years, it has been fairly positive. And that is a same story depicted here on the free cash flow margin. Net debt to EBITDA, very important metric. EBITDA, earnings before interest, tax, depreciation, amortization, shows us the balance sheet strength as well as dividend safety. 2022, it would have taken them 0.2 years to pay off all of their debt net of cash on hand, below the 1.5, and 2023 expected 0.15. So that is very positive to note. Very, very strong balance sheet, and that dividend does remain to be safe. So let's jump into the valuation of ExxonMobil. Now, typically on the channel, for those deep dives that we do, we run through every single one of these models, getting to our intrinsic value. Now, for today's episode of ExxonMobil, the intrinsic value is coming to $127. So let's get to our acceptable buy price. And before we do that, just to let you know that I am doing a free weekly newsletter that will be coming into your inbox. It is completely free. If you want to subscribe, click on the pinned comments below. I will be dropping newsletters discussing my 7 golden dividend metrics. I'll be running through companies that we've analyzed, pretty much saying what our margin of safety has been and any stocks on the watch list. Now, jumping back through to the valuation of ExxonMobil, margin of safety that we typically start off with is 10%, which we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. Looks to be a buy at 10%, at 15% a buy at 108, at 20% a buy up to 101, and 25% not too far off that current trading price. So around $95, it is edging now towards a 25% margin of safety. In terms of Wall Street and what they forecast, well, they see a price target over the next 12 months of $128 with upside of 33%. So they do believe that ExxonMobil right now is a strong buy. Now, I will discuss my strategy for the oil and gas, but I will give a general overview at the end of the episode as opposed to running through and discussing each company. Now, what we can look at, and we'll look at it now, is essentially insider buying, insider selling. Now, we've used our filters for the 4 oil and gas companies that we're discussing today. All buys and sells, at least 100 shares, really any price within the last 3 months. So there's been no insider buying or selling from any company other than ExxonMobil, as we can see here. The insider, Jeffrey Uben, the director, very, very wealthy. And as we can see, he did buy around 26.5 million worth of shares on the 6th of November last year. And we do see in actual fact he sold a lot more shares at the end of the same month, and we can see around 216 million, and we do have the prices that he did buy and sell for. Now, what I do typically say on the channel, insider selling isn't really a bearish signal. Insider sell for many different reasons, personal reasons, financial reasons. The only thing I would say is that insiders tend to buy for only one reason, and that is because they do believe the company's share price will increase over the next few years or the next few months. So whilst that is a bullish signal that he did buy, it is important to note that at the end of the month he did sell, and in fact he sold a lot more shares. So let's jump into the second company today. It is BP PLC. As we can see, over the last year down 4%. Again, pretty much trading at the 52-week low. Forward yield of 5%, forward PE of 7, and over the last 10 years, you would be down on your position by just under negative 30%. Dividend safety then, lower than the previous stock we analysed, 50 borderline safe, 95 billion market cap, a large cap company. Now, when we take a look at those recessionary metrics, they maintained the dividend during the last recession, below average growth, but they did outperform the S&P, negative 45 to negative 55. Now, let's take a look at dividend growth. Well, a very, very mediocre increase of 0.1% in November. We do see negative growth here and 0% over the last 20 years. One thing to note, though, this is a UK company and the FX rate will essentially have an effect on those increases for any other non-UK residents. And we can see they have been increasing that dividend for the last year. Now, dividend yield theory, we can see the sign of undervaluation, the current yield 5.07 versus the 5-year average of 4.92. And we do see the forward PE pretty much in line, 7.7 versus 7.6. So it is significantly lower than that energy sector PE of 12.2. So let's take a look at their free cash flow payout. Now, we do notice over the last few years it has been very low. 2023, 22%, 2024 expected 31% as well. So I would like to see this November a much higher increase to the dividend at a minimum in line with inflation. Otherwise, there's no real point if that yield is 5, 6, 7%, if every year it will be eaten away by inflation. Free cash flow per share then, well, 18 cents negative in 2013, 152 in 2022. It is increasing over the period, which is still positive to note given the volatility in the industry. But similar to ExxonMobil, 2023's annual report is expected to show a drop from 2022. Sales growth, I won't spend too much time here. Very similar for all the companies with their cyclicality. And again, you can see that on the sales growth here. In terms of shares outstanding, well, as we can see from 2013 to 2022, there has been a lot of action, share buybacks, share issuances, but it has been a net movement of 0, although we do know in 2023 it is expected to show around 1 billion worth of buybacks. ROIC then, the last few years have been fairly positive, 2023 at 30%, but again, oil and gas companies do not expect ROIC figures to be very consistent. And then when we look at the margins, again, a very similar story to the previous one, as we will see in the other ones moving forwards. Net debt to EBITDA, we do see a few years where it was shockingly high, and that was the years where the share price did crash significantly. 2022, 0.31, 2023, it is expected to go higher. The positive news is that it is still below that 1.5, but just because of the fact that it is starting to increase, it would be one I would recommend just to keep an eye on. So let's get into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Margin of safety for BP, we'll start off with 10%. It is a buy up to 39.69, 15% a buy up to 37, 20% a buy up to 35, and at 25% it isn't quite there yet. So with BP, we see around a 20% margin of safety. Now, in terms of Wall Street and what they forecast, well, they see upside of 30% or just under, with a price target of $44. So again, BP is another strong buy according to Wall Street. As always, when we are running through these companies, do let me know if you have been adding to any, or if not, do let us know as well. The next company we are taking a look at is the giant Chevron Corporation. Last year, well, down 20%, again, right there at the 52-week low, yield 4.3%, and we can see their forward PE of just under 11. Over the last 10 years, well, you would be up 22%, but we can see it has been a very rocky ride over the last few years. Dividend safety, 90, very safe. In fact, this is the company or the oil and gas with the highest dividend safety score, just something to note. Market cap, 267 billion, a mega cap company. In terms of those recessionary metrics, well, they increased the dividend below average growth, but also outperformed the S&P 500. In terms of dividend growth, well, this is one of the best, 6.3% in January last year. So we're expecting an increase this month, so it will be nice to see where that is headed. 6% over the last 5 years, 7% over the last 20 years. Very, very positive to see. And they are a dividend aristocrat. They have increased those dividends for 25 years or more, but they also have been increasing, or in fact not increasing, but paying without a reduction for 111 years. So that is very, very strong. Now, in terms of dividend yield theory, we have that sign of undervaluation, 4.26 versus 4.05. In terms of the forward P, 11.2 versus 12.7. So it is a double sign of undervaluation, with the energy sector PE still higher at 12.2. In terms of the free cash flow payout, well, the last few years below that 60%, I personally look for 2023 at 55%. So I would like to see at least an inflation increase from Chevron this week or in the next few weeks, but I wouldn't be surprised to see a very consistent 6 to 7%. Negative 156 in 2013, $20 in 2022. We can see 2023 is expected to go lower. A very common theme with all these companies we've analysed. Again, a very similar story on that sales growth with the cyclicality. And when we look at the shares outstanding, again, very minimal as a net position, 1.93 to 1.94, although we can see in 2023 it is expected to reduce by quite a little bit. Now, in terms of ROIC, again, shouldn't be surprised the inconsistency as well as the last 3 years at fairly decent numbers. In terms of the operating margins and free cash flow margins, we can see the last 3 years on both of them looking very well. But again, one thing I do say on all of these cyclical companies, you do want to be buying them when they are out of favor, when they are out of cycle, and then riding them up in the cycles. So net debt to EBITDA 0.17, very low. Last 12 months, so 2023 expected 0.31. Again, very strong balance sheet. That dividend does look to be very safe, as we can see. So let's jump into the valuation model, and don't forget, for those that are interested, if you do click on the pinned comment below, you can grab a copy of the valuation model, getting to the intrinsic value and acceptable buy price of companies in your own portfolio and those on your watch list. So 10% margin of safety, it is a buy up to 156, 15% up to 150, 20% around pretty much the current trading price. So we do see Chevron as having a 20% margin of safety. What do Wall Street say? Well, they see upside and a price target of $180 with 20% upside over the 12-month period. So again, another strong buy for Wall Street in terms of Chevron Corporation. We then move on to the fourth company, which is Shell PLC. Now, this is the only one that is in fact up over the last year, up 5%, but we can see over the last month, similar to the other companies, it is down 5 to 6%. It is trading in the midpoint of the 52-week range, which, as we saw with the other three, they were right there at the 52-week lows. Forward yield 4.3%, forward P 7.71, and over the last, if we take a look at the last 5 years, we can see it has gone from around $52 to 61. So this is the only one that we can see over the last period. It has actually gone up. Dividend safety, interestingly, it is the lowest score at borderline safe, 45. Market cap 196 billion, a mega cap company. Maintained the dividend during the last recession, as we can see here, below average growth, and they did underperform the S&P with a negative, or in fact outperform, the S&P with a negative 42% return versus negative 55. Very, very high increase in July 23, but again, don't forget, similar to BP, this is a UK paying company, and therefore the FX rates will slightly change based on that growth rate. And we can see they have been increasing the dividends for the last 2 years, and we do note that 2019 they did cut the dividend, as well as 2003. So let's take a look at dividend yield theory. So we can see another sign of undervaluation, that yield 4.32 above the 5-year average. But we can also see here the forward P pretty much in line, 8.8 versus 8.8. And it's no surprise, energy sector is higher at 12.2. So let's take a look at the free cash flow payout. The last few years have been very low from 2020. 2023, again, expected to be low at 20%. So hopefully we do see a nice double-digit increase this summer from Shell. Free cash flow, 7 cents to 6.24. Again, it is increasing over the last 10 years. There are some inconsistencies, and again, a very similar drop to 2023's free cash flow per share. Again, very similar, we have that cyclicality, and when we look at these shares outstanding, it has in actual fact increased, so your position would have been diluted as a shareholder if you had bought in 2013 versus 2022, as we can see here. And when we take a look at the ROIC, a very similar story to be told. The last 3 years, double-digit increases to that ROIC, which is always very positive. Margins the last 3 years as well, although we do note the free cash flow margin has been very strong from 2017, but the operating margin has only been looking okay from 2021, whereas we see it slip below that 12% that we like to see. In terms of net debt to EBITDA, very similar story to all of the 4 oil and gas companies we've reviewed, including Shell. Very strong balance sheet. That dividend does remain to be safe, 0.72 expected in 2023. So in terms of the valuation for Shell stock, the intrinsic value is just the average of these 4 on the screen, and it's coming to $79. Now, a current price of $61, we start off with that 10% margin of safety. In terms of using 15%, it is a buy up to $67, at 20% up to $62, and 25% it is still not there just yet. So it has around a 20% margin of safety, and we can see around 21% upside over the next 12 months with a $74 price target. Now, personally, I do believe that the oil and gas industry does still have some way to come down, especially with all the geopolitical risks that we are now seeing, especially in the Middle East. So whilst I do believe they are all trading at a very strong margin of safety and the upside is around 20 to 30% for every single one. Now may be the best time to dollar cost average, and it is something that I will start to do to my own portfolio as I don't hold the oil and gas industry. In terms of picking the best ones for me personally, I do like Chevron Corporation and I do like ExxonMobil. One of the things that does stick out to me though out of the two is the fact that Chevron Corporation have been increasing those dividends at above inflation over the last year, over the last 5 years, and over the last 10 to 20 years. So Chevron Corporation will be the one that I will be looking to dollar cost average into my portfolio, making it the first oil and gas company in my portfolio. In fact, both of them are very strong. They've been increasing those dividends for quite some time, but they've also been maintaining the dividends for more than 100 years. So that is very positive to see. And they both had a dividend safety score of 80 to 90. Now, I do think they will fall down further, increasing that margin of safety. But as we can never time the market, it is very hard to know when to dollar cost average in. Final thing to basically discuss is their return performance over the last year and 5 years. As we can see, over the last year, the best performing has been Shell, up 9%. And when we do expand that over the last 5 years, what we can actually see is that ExxonMobil has been the best performing, up 71%. Chevron up 54%. Bearing in mind these include those dividends reinvested, with Shell coming in at third and BP coming in last. Now, one thing just to remember, past performance is never an indicator for future performance. So always bear in mind, just because, for example, ExxonMobil has been the better performer, it doesn't mean they continue to do so. And they have both Exxon and CVX done acquisitions recently over the last few months that they hope will propel them to higher highs in 2024 and beyond. As always, if you've enjoyed today's content or just the content where we have been analysing companies in the same sector like we did the healthcare yesterday, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And as always, have a great day. Don't forget to sign up to the newsletter. It is completely free in the pinned comment below. Grab the valuation model too if you are interested, and see you all in the next one.